I've noticed a few things that make me wonder if the structure might be fundamentally flawed for a specific early stage investor. You're producing income by way of management fees and not from the wins that you're generating. Just because this one investment might triple or quadruple your money, it needs to return the entire fund before carry can be had.
Is venture capital and early stage consumer broken? In today's episode of Consumer VC, I sit down with Manica Blain to find out. Over 10 years ago, Manica co-founded Campfire Capital, where she raised one of the very first dedicated early stage consumer investing vehicles, a $32 million consumer fund that would go on to lead the Series A for FIGS and invest in brands like Cotopaxi. Then she started her own early stage investment advisory fund, Top Knot Ventures, this time with her own capital. She's made 15 direct investments so far, and several in beauty and wellness have become breakout brands like Everest, Sahajan, and Sweet Chemistry, to name a few. She is also a Beauty Independent Beacon Award winner. She won Seed and Small Growth Investor of the Year in 2024 and is considered amongst the most active angel investors, backing the next wave of standout consumer founders and brands.
Denver should have the ability to kick you to the curb if you're not doing what you said you were going to do. If you're not paying for something, you don't use it. There comes to a point as an investor where maybe you just have to be really honest about what you're not good at or what you can't really be helpful with.
Manica, I am so excited to have you back on again. How are you?
I am good. I'm so excited to be back on again. Thank you for inviting me.
Hardly. Thanks so much for considering coming on. And also, since you came on the first time, you've now been writing these Substack posts that are incredible. Everybody should be subscribing. It's so great. Talk a little bit about what was the inspiration to actually start writing the Substack.
You know what? So the truth is, it was my New Year's resolution a year ago. So I wrote my first Substack on January 1st, 2026. Very recent. We're in week 6 or 7 right now. And I had planned to do it a year ago. And then life gets in the way. Things get busy. I was going through the first exit of my portfolio, Top Knot Ventures, midway through the year. And so it just got really, really busy and I didn't do it. So waking up January 1st, 2026, I was like, I'm doing it. And I kind of had these notes in my phone. Maybe you take notes. I take notes all the time. And I was like, there's so much I want to say. And not that I'm on my deathbed or anything like that, or at least that I know of. But I was like, if I did get hit by a bus tomorrow, how do I get these stories out? And not salacious stories, not in that way, but just things that I've learned, things that I think could be helpful to other people, either early in their careers in investing or somewhere in the middle or towards the end for founders, and then the other thing that would happen too is I love contributing to Beauty Independent, modern retail, shout out to, the Gabby Barkos of the world and, the Rachel Browns and Business of Fashion. And every time I would do a piece, my LinkedIn would light up and people would say, oh my gosh, I love what you said. And it's like, okay, well, maybe I should just start putting it out there. So anyway, I'm learning. I think I have I don't have many subscribers yet. I think I have 150 or something like that. But what I am noticing, which is interesting, is that my posts get thousands of reads, but the engagement on Substack, I'm like, I don't know why nobody wants to subscribe. It doesn't cost anything. Maybe I should make it cost something. I would never would. I'm not doing it to monetize.
I will say, if you do want to make it premium, I think it's worth premium. I'm honestly not just saying that. I think that just from your story and everything that you've done on the investing side, and also you were OG consumer, and everything. Listeners, if you haven't subscribed to it yet, it's you win some, you lose some. It really, honestly, if you really want to understand what consumer investing is about, and also if you can even make money in consumer investing, which I want to get to, and the DB, you can. But also, if you can make money early stage as a fund, which I'd love to dive into, it really is an absolute treat. And I feel like I learned so many.
I'm really enjoying it. Like I said, I'm on number 6 or 7 right now, and it really just is that. It's you win some, you lose some. It's just stories that I share, anecdotes, learnings, kind of realizations that I've had after what is now over a decade of being an early stage consumer investor.
Totally.
But I still look like I'm 21, right? No?
Of course, of course. Absolutely, absolutely. Now, also another point of congratulations goes to you, not only because you started your Substack, but also you had your exit that returned your fund, which well, not your fund, returned your entire portfolio when it comes to angel investing, correct?
Yeah, so it 2x. So I had one exit last year, late last year, that returned a 2x on all of the capital that I put to work within Top Knot. So I have 15 active investments right now, and that one exit. So it just goes to show you that there are businesses within consumer that can scale an exit. They're not all going to be sexy ones with headlines. This one particular exit is still private in terms of a public disclosure, but it was a great win for me. It was a great win for the founder, for the team. I'm excited. The acquirer is doing with it. I'm still on board, helping out in several capacities, and I participate in. There's an earnout component as well. So I participate in the earnout as well, and I'm still a part of it. So it's exciting.
Incredible. Congratulations. How has that exit helped shape your thoughts when it comes to investing in consumer at the early stages?
You know what? It's without giving away all the Substack. I have a specific post on, the founders that win, and I speak very much about this one particular exit. It's it's really helped me like double underline what I've seen in founders that win in situations where an exit actually does come to fruition. And I want to be clear, like, I don't think there is a little bit of pattern recognition in some things, but some things surprise you too, right? But it's affirmed for me just instinctually what I've seen across the board in situations where there has been a strong outcome. I think that was fun. And sometimes when you're doing something on your own versus when you've done it in collaboration with others or as part of a fund, sometimes you wonder, is it me that can pick winners and help them, or it like and so it was really affirming for me to have my first big exit within my own vehicle. um just knowing that, okay, maybe I do know what I'm doing here. I know that sounds weird to admit to, but it's the truth.
Not at all. Not at all. And congrats again. And when did you make the investment? Was that what was about 4 or 5 years ago? What was one of your first investments?
Yeah, so this was one where I got involved in. It was July of 2022, and yeah, it's I can't share too much about it without giving it away. I wish I could, and I hope the founder can one day speak about it too, and speak really openly about it. And I'm sure she will. But anyway, it's yeah, it was an exciting year.
Cool. Um, Incredible. What did you so I know that you obviously had a fund, Campfire, and then now you're a full-time angel investor. You've been an angel investor for some time. And I know you've recently written. I think when we first chatted, I asked, and I know that this was another one of your Substack posts about a person that is a dear friend of yours that caught up that said, when are you raising your next fund? I know I asked you that question as well. How do you think about funds, early stage consumer funds today and that entire structure?
Yeah. So when you say funds, because I guess I have a fund right now. A fund can just be a vehicle, an organized pool of capital through which you invest. But when I think about, I think I know the article that you're referring to, and it's more about the GPLP structure. So it's a fund where rather than my current fund, which is today backed by my own capital, my own balance sheet, I don't have any investors. I don't have any third party LPs in my fund. But one of the, I shared a post recently about the various reasons why I've decided not to go about raising third party capital for a GPLP structure. So one where you have a GP, obviously, and then third party investors that back your fund. I think that's what you're referring to, right?
Yes, indeed. Indeed. So the GP to LP structure, why do you believe that that's fundamentally broken for early stage consumer? What's the core argument?
There's a few. And what I will say is first off, I'm so grateful. Like when I started in my first fund, when we started Campfire Capital back in 2014, it took us a little while to raise it. We closed it in 2016, in terms of the fundraising. And it was just such a different landscape back then. There were so few early stage consumer investors, like investing when a company to near early stages, when a company is like $1 to $5 million top line. Like that to me is early stage consumer. It's not seed or pre-seed or series A, because I feel like the lines get so blurred. I'm talking about that realm of how big a company is. Back then there were just so few. So in a way, I'm so elated and happy that there are more vehicles, more funds that exist to invest in those businesses that are in that realm. But I think I've noticed a few things that make me wonder if the structure might be fundamentally flawed for a specific early stage investor. And I went into it in my piece from just earlier this week. But to recap a few of them, one of them is just the GP commit, across the board. I meet with emerging managers often today. I am an LP in one other fund, consumer fund, and I have looked at a few funds to invest in. But one thing that's always given me pause as I've met with some of these emerging managers is just the size of their GP commit as a relative to the whole fund. And so what I've heard and what I see often now is that market, right, is more like 1%, 2% of the fund should be the GP commit, and then go raise a bunch of other money. So basically what that means is if you're raising $100 million fund, just to put an easy number on it, the GP commit should be 1 million, right? And that could be spread across your 3, 4, 5 partners, however many you have. And to me, it just seems low. Right. I think that financial alignment of interest is something fundamentally important to any investor relationship. When you're managing someone else's money, if you feel like you're writing a check and a meaningful portion of that check isn't your own capital, I think it just changes the way you think about placing that capital. I think it changes the way you are a steward of that capital. And that's just my own point of view and where I came from in my career investing. I came from a private equity fund. I spent almost 5 years there, where it was always very much embedded into that firm's culture that, everyone around the table, whether you're like at this point, senior associates and even associates alike, could write checks into the fund. Everyone around the table needs to feel like they're participating in that investment to make the right call. Because if you are just managing someone else's capital and it's not enough of your own capital, it just creates a different alignment of interests. So that's one point.
Yeah. So on that point, do you think then rich people should raise? Do you think then that only rich people should raise a VC fund?
No, not at all. Not at all. Not at all. I think that, like, in my case, just to take a rewind and a step back, when we raised Campfire Capital, I was in a GP relationship. There were 4 of us in the GP. And, very, very truthfully, it was about 2.5 million was the entire GP commit. My GP commit, as like Manica got him at the time, my maiden name, it was $100,000. Okay. But I was 32 years old. And back then, $100,000 for me was more than 10% of my own net worth. You know what I mean? You think about like my assets and what I had. And so it was really, really meaningful for me. However, because we were raising, at the time, we didn't know if it was going to land at 30 or 40 million. It was important to align ourselves with others that could also put in meaningful capital. And that's not specifically the reason why the 4 of us ended up in partnership, but we did have a good rounding out of individuals that could write much larger checks, such that our whole GP commit, while individually meaningful to all of us, was collectively to our fund meaningful as well, if that makes sense. We were around 8%, right? So if you think 8 out of 32. And that to me is a much healthier mix, because it felt like every time we were writing a check on behalf of our fund, 8% of that check was our own money, like the 4 of us looking at each other, right? And so it just created a much different level of care, quite frankly.
Did that though, with you all putting in different amounts that summed up to 2.5 million, did that at all create tension? Just kind of curious in terms of that. A couple people would.
I would say no, actually, because and then this was maybe just the way that it worked out. I was the person of the four of us that was probably the most responsible for fundraising. And so a lot of the relationships that came in, as you know, our fund was backed by 33 current and former Lululemon executives at the time. Those were 100% my partner's relationships for sure, but they accounted for maybe 3-4 million of the whole fund outside of the GP, right? So when you think about the $32 million fund, a lot of the relationships that came in outside of that Lululemon group, many of them were like BDC was a $6 million check. The very first investor in our fund, it was $1 million check, and it happened to be my uncle's best friend, right? It was a lot of like my relationships as well as my partners. So even though I came in with a lower personal GP check, I mean, my Rolodex was tapped with, everyone within my network that I knew may have an interest in investing in early stage consumer. I was calling them too, as were my partners. All of us were really, but because I wore that fundraising hat, I don't think it created. There are many friction points, but I wouldn't say that was one of them.
So if you don't think that rich people should raise a VC fund, or rather, only rich people should raise a VC fund, but then how do you kind of reconcile that with, funds that might have less percentage? Does that mean per se that folks should raise less money? That it should be like that it should be, instead of trying to raise like $100 million fund, maybe you raise the $30 or $50 million fund? Is that kind of how you reconcile it?
Kind of, yeah. I mean, that's the biggest piece. When I speak to these emerging managers, they're not looking to raise $100 million funds. They're looking to raise like,
Sure.
10,
20.
$20, $30 million funds. And so when I look at their GP commit, as, in some cases I've seen less than 1%, and there's two of them, and I know they have more money than, like, do you know what I mean? Like, I don't need to be. To me, it just looks off. It just looks a little off. And again, this is not. I don't think there's any hard and fast rules. For me, it was just really a general observation that I think that in a way we encouraged many emerging managers to come into the industry, which on balance I think is great. May have led to some other consequences, but on balance, I think that's great. I think the diversity is great too, because to your point, I don't think it's just rich people that have a good nose for brand at all. I just think that you need to really be all in. This is a commitment. Managing third-party capital is not something we decide to do on a Monday and hand back keys on a Friday. It's a long-term partnership. It's a long-term commitment. And I just feel like there needs to be more actual alignment.
That makes sense. I'm just kind of curious, because you're an LP in a fund, and because I'm sure that you get pitched all the time to be an LP in other funds. If on like a deck, like the GP's deck from terms of fundraising, if they actually put this, and again, this is just your perspective, it's not anyone else's perspective. They actually put, like, if you felt like the number was low, right? They actually put how much they actually have, like their full kind of portfolio, and then they said like this is what percentage of portfolio, like the percentage of how much they are worth actually going into the fund. And even though it doesn't maybe seem that much on paper like a lot, it could be a lot to them because it is significant. Does that change at all your perception?
I think so, for sure. Yeah, I think so for sure. I think I've never seen that. But I think
it would be interesting. It would be
interesting, yeah, because I mean, the main point here is that it needs to be meaningful to the person.
Significant,
You feel is truly skilled in being able to identify, support, grow, and then help these businesses reach a certain scale to then exit. If you feel that this person, let's call them, Jane Doe or John Smith or whomever, I mean, that would be really great to understand as an LP, not just them saying this is a significant portion of my net worth. Like, can you show me that? Like, I don't know. I feel like I'm not sure if you'd be allowed to do that as an LP, but if the GP wanted to voluntarily disclose that, I don't think it would hurt.
Yeah, I don't see how it would hurt, but maybe I'm wrong. I don't know. I think that's actually kind of pretty cool, to be honest with you, saying, hey, this is how much.
Similarly, I mean, now that you're speaking, you're saying that similarly, if it was somebody with hundreds of millions of dollars, raising a $30 million fund. And if their GP commit was $1 million, similarly, would you feel good about that? Not really, right? Because it wouldn't be, it'd be a little bit of a drop in the.
Because if the opportunity is there and you're so passionate about the opportunity, why then aren't you capturing all of it?
Exactly.
Right?
Yeah.
Right. Understood. So what's your next point about why the GPLP structure is broken?
Yeah, the next one that I wrote about, and I don't know if people really understood it, but it was that when you have a win in early stage consumer, it can sometimes be this like fund maker, great, return where it returns your entire fund. But because of the way these GPLP structures are typically written in an LPA, a limited partnership agreement, you're typically under something called a European waterfall, which is like a whole fund waterfall, which means that in order for the GP to really win financially and economically in the upside of something going well, they need to return the whole fund. So American waterfall would be like a fund, a business by business one, where if you invested in something and returned, a 3 times or 4 times capital on that, then you could take carry out of that. But a whole fund waterfall means no, no, no. Just because this one investment might triple or quadruple your money, it needs to like return the entire fund before carry can be had. And carry, when I say carry, I mean carried interest, which for a GP, a fund manager, just I'm sure many of your listeners know what this means, but just in case they don't, essentially what it is it's the mechanism by which the GP gets rich. It's the percentage of profit of the fund that the GP gets to take home. Typically, it's 20%. I've seen it as low as 15. I've seen it as high as 25 as well, but typically it's 20%. And what it means is that using really simple math, if you have a $100 million fund.
This episode is brought to you by the Hidden Gems. Let's be honest, there's a lot of bullshit in the marketing agency world. So much under-delivering, overcharging, and incompetence. You truly don't know who's good until you engage. And by then, it's too late. That's what the Hidden Gem solves for. Powered by deep agency insider knowledge, they provide founders and brand operators with only brand beloved, highly vetted boutique agencies at preferred rates. Agencies across media, creative, dev, design, events, social, and beyond. All well covered. The Hidden Gem serves brands like Dr. Squatch, Monster Energy, Gorilla Mind, FIGS, and Saatva to achieve some of their biggest growth. And here's the best part. David Drexler, the founder, is offering his service free forever to anyone in the conservative VC community who mentions the show. So if you're thinking about hiring an agency, talk to the Hidden Gems first. It's free service, biggest bang for your buck. You simply can't lose. Link in the show notes.
And that $100 million turns into $200 million after fees, expenses, and all the rest of it. That's $100 million of profit. 20% of that is $20 million. And so $20 million would be what would go to the GP. Now I'm leaving out hurdle rates as well, which complicate it slightly. And what those mean is that beyond just returning a whole fund, the earliest instance in which a GP can collect carried interest is when they not only just return the whole fund, but the return that they're making is over a certain point. Typically, it's 8%. Again, I've seen it lower than that. I've seen it higher than that. It basically means that you need to return everything and then provide an 8% return, and then you get the benefit of getting 20% of the profit that you're generating for me. It's, how the LP thinks about it.
Wow. So
what I'm meaning by that is the way that the structure works currently under the European waterfall means that even if you're a really skilled investor and you have an early win and it's year 3 or 4 or 5 and you've returned back all of the capital, you're not really benefiting in any profit that you've generated for your LPs yet, because you might have 10 other portfolio companies that haven't yet generated a profit. And so I think that delay in the win for the GP creates this other somewhat hazard to me, which is that typically they end up going to raise larger funds to be able to win financially through stacked management fees, right? Which means that, okay, you've got one fund that's returning, not returning, but paying you a certain level of management fees. You raise another fund, you're now getting management fees on that fund. You're producing more income, but you're producing income by way of management fees and not from the wins that you're generating.
Yeah, but on that note, and maybe it's typical, or I mean, I know it's fund dependent, and all of this is maybe fund dependent in some capacity. But on the management fee side, doesn't that typically get more like front loaded in a fund? And that's the reason why it gets front loaded, where you get like 2.5%, for example, for the first maybe call it 3 to 5 years. And then if it's a 10-year fund, and then it might go to 0 or like 0.5, the rest,
Yeah,
because
because we're
I
getting
think that
really technical now, but typically
yeah,
there's a commitment period and there's an investment term, right? So
yeah.
typically a 10-year fund life, but a 5-year commitment term means that you would get 2% or 2.5% or whatever the management fee structure is on committed capital. And then in years like 6 through 10, you still get paid management fees, but it's now on invested capital. Do you know what I mean? So as long and so in a weird way too, I want to be really careful as I say this, but you know, there are some businesses that should end up as zeros. But if it turns into zero, it's no longer invested capital. It's still capital that's invested. And so that GP would still get paid a management fee on invested capital.
Oh, interesting.
Yeah. I mean, at least
Interesting.
and I don't think I don't think there's a bunch of bad guys out there. That's not what I'm saying at all. I'm just saying that I think at the very least, if GPs were able to win early on their wins, I think some of these potential misalignments of interest might dissipate.
So are you maybe are you pro, not that you're pro anything, you're just kind of pointing out, some of the
I know, and to be
some
honest,
of
I
the
don't have
pros
the
and cons.
answers. I feel like
Yeah.
I wish rather than just sharing
I
the things, yeah, I
no,
don't all
I'm
the
just
solutions that I don't come equipped with that yet. But open
I'm
brainstorm.
yeah, no. I'm just kind of wondering, do you think, for example, the SPV model for early stage, does that make a lot more sense if you are raising capital that isn't your own capital, right? Like you actually still have LPs per se. Does that actually make more
100%. I
sense?
think
And
the
and
SPV.
is there more alignment there? I guess that the hard part with the SPV model is, of course, your salary or the management fee, which usually that's not existent. But do you find that like that feels a bit more aligned? Because then as a GP, I'd imagine you can actually, once you get that win, you actually see that win yourself.
Totally, totally. I see a whole bunch of other problems with SPBs, but maybe we can leave that for another podcast.
Okay.
But
Okay.
but
Okay.
but for this specific point, absolutely. I think it makes a ton of sense because you do all win together when something turns profit. And so there is. I mean, an SPV is essentially just that. It's an American waterfall done 10 times or however many times you choose to invest or bring a deal to the table. Um, I think, you know, I think it's a smart route for somebody that is really passionate about investing, that finds a great deal. I think there are certain flaws with it as well. I get pitched SPVs all the time, and I get pitched SPVs by folks where I'm just like, "Do you actually really believe in this, or are you just excited for me to invest and you can collect a management fee and take a bit of carry off me if this does win? And like, how much are you also putting in?" So there's still issues with it. But I get it. I get it. And it makes sense to me from the GP's perspective why they would want to do SPVs, and I think from the LP's perspective, it does more balance that issue.
It seems like part of your frustration, I guess, back with SPV, which is similar to which is similar to your first point, is do you actually have skin in the game? Are you raising an SPV just because, hey, it's a deal and I'm gonna be able to raise this, and then hey, if it works out, I'll get 20% of the carry. And I don't know. I don't even know if I haven't come across SPVs where they actually have management fees, but I'm sure there are. Um, but
It's like typically like fees and expenses, which is
the
totally
fees are expensive.
fair.
Okay. Yeah.
But there's
Okay.
typically like a fee and there's carried interest on it as well. And
But I guess it goes back to your first point of, okay, great, you're helping to put this deal together, which is great, but do you actually believe in this deal, and how kind of involved are you? How deep are you on this deal, instead of just writing up like a deal memo and just blasting it out to your network?
yeah. Yeah, for sure, for sure. I think when it comes from somebody that's deeply close to the business, as a real hands-on advisor too, I think that helps a lot too because it affirms that person's conviction around the business and commitment to to really lean in and supporting the business. But yeah, to be honest, the reason why I've never done an SPV, and I don't think I ever will. And part of the reason why I don't want to do it, and I don't think I ever will, is that I do have a really deep network of investors that I'm close with, that I share opportunities with. But I want those investors coming into something that I'm coming into because, like, they know I'm not sharing this with them because I just need to, like, fill around and get it closed so I can get paid. Do you know what I mean? Like, it's like I want somebody coming into this and writing a check because I think it's
You want that. You want all that money. You want them to realize the gains themselves, like 100%. You don't want you to be. You feel like there's some type of misalignment if just because you happen to bring them the deal, right? Which I'm not saying like it's still work to put together a SP. I'm not saying it's not, but just because, but essentially, it's sourcing, right? Kind of essentially in terms of it,
And
but
listen, I'm all about everyone getting their bang, getting paid, like, for
yeah,
what they do and the work that they do. It just it's never felt great to me, and so it's why I've steered away from it. If I share an opportunity with a family office I'm close with, I want them to know that I'm gaining absolutely nothing from them coming in, but I'm writing a check. I think it's a great opportunity, and maybe I am doing other advisory work with that business. I often am. Not often, but I am sometimes, I'm getting paid from the company through other works that I'm creating with them and other work streams that I'm helping them lead. But I just don't feel great about, you know what I mean, making that call and being like, well, if you write this check in, I get 2% of it. It's like it feels like it just doesn't feel right to me.
yeah, it makes a lot of sense. It makes a lot of sense in terms of from that perspective from an SPV. Well, I understand it from your perspective too, just because of how wide your network is. I understand it if if you're a person at the middle of an SPV or putting together an SPV, and maybe it's people that that maybe don't have access or don't know about a particular space, and you're kind of the go-to person. Now, that doesn't mean you're taking advantage of anybody or anything like that, but the purpose is that you're kind of like serve as a bit more of like the education partner for someone learn the space. Then like that's
Yeah,
yeah,
I think the reasons why it does work, and I know some people that do it, and I think very highly of them, and I think part of it too, well, first there's two advantages. One, from the founder's perspective, they're not collecting like 20 checks. They get to collect one check from one person.
yeah,
To the person.
yeah. It's like, okay, you want to go raise my round? Go raise my round. That's fine.
Totally. Um, and I also get the perspective from the underlying investor that, gets to go to one person for questions and get answers to those questions. And, this person hopefully is doing a great job of like keeping that investor group up to date with, quarterly, reporting or annual like tax slips, whatever, you like, I think there's merit in it for sure. This is not something I'm doing.
Got it. That makes sense. And then, so that was two reasons in terms of why the GPLP structure is finally broken. Do you have any other reasons why you think that is broken?
Yeah. So the third reason I spoke about in the piece I wrote about was, and I've heard this from so many other GPs as when you're in the work in early stage consumer companies that you're investing in, call it like 1 to 5 million, 1 to 10 million. I mean, they're so young, there's so much to do and so many ways in which you can be helpful. But after a while, it does feel like when you have third party investors, like they're your customers, you're reporting to them, you're raising from them. You're maybe thinking about raising your next fund. So you're out there building relationships with prospective LPs. You're just the entire structure isn't as amenable to being as hands-on as I think you probably would like to be if you're really trying to help these founders and these teams early on move the needle. And so it just takes you away from what I think is the real work in super early stage consumer. Which again is like you've got 5 people around a table, so when you come in as an investor able to help with something, like you've just increased their capacity like by a ton. You know what I mean? By being able to be like, I can help you take that on. Like let me help with that. And you can't do that as much when you're a GP and you've got these LPs to manage, and you have quarterly reports to get out and an annual meeting to host. And then you're, like I said, you're thinking about your next fund. So you're going to conferences, you're meeting with family offices and groups that you're trying to build a relationship with so that they invest in your next fund. It's just taking you away from the real work. So it's I think you and I have talked about this before. It's just that the customer ends up becoming your LP, which totally makes sense, right? They are effectively paying you, but I think it takes you out of the real work.
Yeah, and what's interesting is we talked a lot about it we've talked a lot on this show before about how once you raise from venture capital as a founder, you're kind of on a hamster wheel, and maybe that means that you're going to raise and raise next. It's kind of the same things for VC funds, right? It's the same, it's the same exact thing. How are you going to raise the next round? I mean, or the next fund, and that fund has to be bigger, right? And everything.
Yeah.
That's why I'm so impressed with the funds and firms that actually stay their same their size, or even say, we invest in Series A and seed, but we actually see a lot of opportunity in pre-seed, for example. Let's go actually a little lower and let's go earlier. Like, that's so impressive in my opinion, because as you say, if you raise at a smaller fund, your management fees are not nearly going to be as big, and there's a lot more, I would say, risk that comes with your job, right? And that's really hard.
It is. It is. It is. And yeah, I mean, listen, all I can share and I, and I'm happy to share more publicly here with you, and I plan to do so with my Substack as well, is that I think the GPLP structure, while I think it absolutely belongs in this ecosystem, I need it in this ecosystem. So do founders. I think there's room for other structures. And I think, how I've kind of accidentally structured Top Knot Ventures is that not only can I write checks, and that same GP commit that I would use for a fund, I now use to write direct checks into companies. And in terms of like how I earn a living and my salary, it doesn't come from management fees, but it comes from me putting it in my hand and actually doing real work with actual companies in my portfolio. And it's never, ever a pay to play. I never invest in a company and say, hey, I'm going to invest in your business, but you've got to hire me to do like A, B, and C, and D. That's never how it works. That's never going to be how it works. I will write a check into a company and kind of put my own little sandwich board of like, here are the things that I know how to do really, really well, and that I'd love to be able to help with if and when the time arises that you need that, come at me, sort of thing. And that's how I earn what would otherwise be my salary as a GP, and look, in comparing notes with other GPs and knowing what I got paid as a GP, given the fund size that I had, I'm actually doing quite a bit better this way financially.
That's really interesting. That's really
And,
cool.
and like I said, I really don't mind sharing this because I'm not the kind of person that wants to hoard. I feel like I found something where there's space to play. I would love to have more Top Knot Ventures out there that I could refer people to. That I could say, hey, like, I'm at capacity right now. And actually right now I truly am. One of the reasons why I wanted to do the Substack too is this just a way that I can share more and be more additive to the overall ecosystem without taking every single call that comes into my LinkedIn or direct messages me? Like, it's tough, right? And again, what I've learned is that there are enough Top Knot Ventures out there, and I want to encourage other people to take that route if they can, because to my point, it can be far more lucrative. You get to really feel your wins, and you're way more aligned with the founder, and you're in the work. You're actually in the work. My calendar is no longer filled with, I got to get that quarterly report out to, my investors. I got to plan my annual meeting. I got to produce this templated one pager that this institutional investor needs me to do every year. Like, it's none of that anymore.
Yeah.
And so it just keeps me in the work that I love.
How do you think, that's fascinating. How do you think about, because sometimes you talk to companies, I talk to companies and said, hey, would love to bring you on or have you be part of this company and help on the operating side in terms of your skill set. We can give you advisor shares, or we can give you some type of equity to do it, but we can't actually pay you. How do you reconcile that that yourself in terms of when it makes sense to maybe take advisor shares where you're actually doing work versus actually a salary or some type of
Totally. Yeah. And
compensation?
it's taken me a while to get to this place. When I first started, I didn't really have a view and I didn't really care. And I was sort of like, well, if you can pay me, you can pay me. If you can pay me in advisory shares, you can pay me in like it was sort of just like,
Yeah. How do you think about structuring it now?
totally. I think actually my very first advisory agreement that I went into was sort of like, well, here's all the things that I can do for you, but like you just tell me what you want to do, like whatever. I mean, it really was. And I'm not saying that's the way that you should go about selling yourself. I think I had my own confidence issues to work through in my early days of getting this set up. But what I've learned, my own notes that I'm happy to share with you and the world clearly, is that the best structure for me is a combination of cash and equity. And I think you should be really clear when you take on those roles of being very explicit about how exactly you're going to be helpful. And I think in order to maintain ultimate founder friendliness, which is sort of my motto in life, that founder should have the ability to kick you to the curb if you're not doing what you said you were going to do. I've seen so many advisors on cap tables where I'm sort of like, what do they do? How do they help? And it's sort of this, well, like they introduced me to a contract manufacturer that we're no longer working with, but I guess it was helpful. And it breaks my heart. It truly breaks my heart. And I don't think that's fair. And so any advisory agreement that I structure that has equity within it will always have a 1-year cliff. They will always have the ability, to like, if we're in month 2, month 3, month 4, month 11 and 28 days of our relationship, and you feel like I haven't done what I said I was going to be able to do in terms of helping you. I haven't landed the things that we said that we were going to land together. Like, I want you to be able to part ways with me where I get no equity in your business. I just think that's fair. You're taking a leap of faith in bringing me in to help with, whether it be business development or helping you, put together materials and think through fundraising strategies, like run your financial model and act as your fractional CFO. I mean, I do many things. But if you feel like I haven't done what I said I was going to do, I just don't feel like it's fair for you as a founder to part ways with your equity, and in terms of the pay thing.
This episode is brought to you by the Hidden Gems. Let's be honest, there's a lot of bullshit in the marketing agency world. So much under-delivering, overcharging, and incompetence. You truly don't know who's good until you engage. And by then, it's too late. That's what the Hidden Gem solves for. Powered by deep agency insider knowledge, they provide founders and brand operators with only brand-beloved, highly vetted boutique agencies at preferred rates. Agencies across media, creative, dev, design, events, social, and beyond. All well covered. The Hidden Gem serves brands like Dr. Squatch, Monster Energy, Gorilla Mind, FIGS, and Saatva to achieve some of their biggest growth. And here's the best part. David Drexler, the founder, is offering his service free forever to anyone in the Consumer VC community who mentions the show. So if you're thinking about hiring an agency, talk to the Hidden Gems first. It's free service, biggest bang for your buck. You simply can't lose. Link in the show notes.
I think of it almost like a utility. If you're not paying for something, you don't use it. And so what I learned early on as I got started in Top Knot and started to do consulting advisory assignments is there was a period of time where I was like, sure, I'll do this for equity only and no cash. I understand times were tight and this and that. But what I realized is I wasn't being leveraged in the right way because the founder felt like they weren't paying me in a way. It felt like when you're not paying for something, you just don't use it as well. You don't consider it the same type of resource. And so, and also because my model is so founder friendly in terms of not really earning that equity until you feel like, I've actually delivered. I do need to get paid, right? So that's kind of where I've landed, and I'm really flexible. At the end of the day, like it's a long game for me. I've tried to be really flexible with founders, and it's gotten to the point where like I'm only really working with portfolio companies, like in my own portfolio. When I first started, I was doing advisory and consulting with companies that I didn't invest in, and I get a lot of interest. I'm getting a lot of inbounds for stuff like that. But I've decided there's only so much of me to give, and I'm only going to be doing that with companies I'm actually investing in terms of like providing that level of support.
I know, unfortunately, to say this, but not every company that you invest in is going to make it, right? How do you think about time spent overall? And especially if you are working for the company, and have you ever gotten a feeling, for example, when you're actually working for a company and you thought, you know what? What I thought that maybe this is the perfect founder, perfect timing, everything was kind of going their way, that maybe now they have some headwinds that I don't think they're going to recover from. And I don't think that this is going to be quite the outcome that we all expect. Because I know that, when I talk to investors that, once a company, not to speak for all investors, but some investors, once a company, they obviously have a fiduciary duty. I'm talking about the GPLP investors that do have LPs that have venture funds, that they do have a fiduciary responsibility to their LPs to try to spend their time on the companies that obviously are going to be returning the fund, and try to maximize their time in terms of trying to return the fund. When you do have a company that won't be in that outcome, typically the response is, all right, we're not going to be maybe spending that as much time with that company. How do you think about that with your own business? Because this is quite a different model in that you actually sometimes at times do get paid, and you're actually part of like the operating team. And then, but when things are maybe not going as you planned, and maybe you no longer had that belief, how do you think about your own time spent, and if you should still kind of keep working for that company, or even what to do?
Totally. Yeah. I mean, it's such a good question. And I mean, I typically structure my advisory assignments as like 6 to 12 months, right? So it's not like I'm getting paid a retainer forever. It's like I'm very specific in what I'm doing. So as long as I'm still doing that and additive and helpful to the company, I mean, I'm here for it, is the truth. That being said, I can't think of any companies in my portfolio that I have advisory in that I feel that way about, if I'm being truthful. I mean, candidly, of the 15 companies in my portfolio right now, I hold advisory positions with 4 or 5 of them. So it's not an every company sort of thing at all. And those 4 or 5 companies, those are the companies in my portfolio that I feel strongest about. And that's the truth. So I haven't gotten there yet. I'm sure I will one day. I'm sure I'm going to go down an advisory path with one of my portfolio companies where I'm plain and active, really hands-on role, and I don't end up feeling so great about it. But while there are companies in my portfolio that I don't feel great about, they're not ones that I had advisory. So it's a tough one to answer.
Right.
But I mean, one thing I've learned just from investing is,
It's also, I'd imagine, by the way, like
we'll see the whole thing sometimes. So even though sometimes it may even look like things aren't trending the way, you don't always have the whole picture as an investor, and it's not a good thing. That's not a bad thing, but it's just, it's tough to say, right? So what I encourage investors to do when they're in something that, it's not really going the way I thought, well, it doesn't mean that you detach completely, of course, focus on things that are going well, but as best as you can, I think it is really important to continue to be a resource for those founders, without it completely sucking up all of your time, of course. But that's what I've learned anyway.
Yeah, no, that makes sense. And I imagine that's also maybe one of the heartbreaking parts of the job where
It is. It's sort of like this quiet conviction that you need to maintain, and you want to be really supportive, but you also need to focus on the things within the portfolio that are ultimately driving, value, and making sure that your time's spent in the best way.
Yeah, I also, even just to your point about you may not know the bigger picture. One of the points that you made that stood out to me when you first came on the show was how you actually prefer companies that are actually are much slower to get to $1 million than ones that kind of get there super quick. You actually are a bit nervous about that. Um,
I still feel that way.
yeah. Can you elaborate? I know that you talked about a little bit on when you previously on, but can you talk about why?
Yeah, I think that, if you grow really quickly, you've nailed something in the mousetrap, right? You've nailed something in terms of capturing attention, whether it's a viral moment, whether it's a partnership. Like of course, like some things hit really quickly, but it doesn't yet mean that you've built an enduring brand, or that you're building a community that is loyal. And retention, as is just like, it's what everyone is finally talking about, coming into 2025 and now 2026. I feel like it's something I've been saying for a really long time. I've been laser focused on But I'm so glad to see the rest of the market catching up. Because when you speak to strategics and you speak to what they're looking for in their portfolios, and I mean, ultimately, many of us consumer VCs we wish and dream that we can exit our portfolio companies to strategics. A lot of them are looking to fill gaps within their portfolio, and they're looking for brands with enduring qualities, with really loyal, sticky customer bases. And you don't see that within the first year, and you definitely don't see that really quickly when a brand skyrockets so quickly. It could just be a moment in time. It could just be this one trick, this one mousetrap that really worked, and the brand doesn't actually really resonate with the community. It doesn't. You don't yet know. And so I to be clear, where I invest is like $1 to $5 million. So I do come in later. I don't come in day one of a business starting and be like, listen, take all the time you want to get to $1 million. I don't invest, sub a million. I've kind of put that guardrail on. But I really love to see a business that has taken a little bit of time to figure it out, and now they're really starting to scale, and an unlock is happening. And there's proof of just a really loyal, sticky community of people that support this brand, that love this brand, that can't live without this brand. I think I gave the example of Sahajan when I was last on the podcast, and I mean, we just refreshed your cohorts like a little while ago, and they've gotten stronger. Even though the company is my 4x'd since my investment a couple of years ago, what's so great to see is even with that scale, the cohorts, the stickiness of that consumer, it has gotten stickier. They're coming back. They're coming back still. I think when she first raised her first round in the summer of 2023, which is when I got involved and I invested. And at that point, I think it was like 11, 12, 13% of her lifetime value net sales came from customers that purchased 10 times or more. That is now closer to 20%. Can you imagine 20% of your lifetime value net sales coming from customers that have purchased 10 times or more, and you're growing? Like, that's
insane.
incredible. So
Insane.
it's just,
Wow.
it's something that business has been around for over 10 years. Lisa started Sahajan in 2015. So it's really cool to see, and it just reaffirms the kinds of businesses that I'm really attracted to in consumer.
Totally. That's such an amazing story. That's so cool. Why have you stopped investing in food and beverage?
It's so funny because I had somebody reach out the other day. It was a founder and really interested in food and beverage business. And I was almost like, you don't want me on your cap table. I have no track record of investing in food and beverage and it working out. So I think there comes to a point as an investor where, maybe you just have to be really honest about what you're not good at, or what you can't see, and what you can't, really be helpful with, or not even helpful with, but what you just maybe don't have the intuition for. And I haven't had success in food and beverage yet. And maybe I will one day. But it's been a hard category for me as an investor. And so I've taken a pause on food and beverage. Not to say that it's not a great category. It's one that needs to exist. We all eat every day. We all drink every day. It's a category I love as a consumer. I love the trends on net. I love all of it, but it's just not one in which I've seen success yet. And so I think it's made me pause on the category.
That makes sense.
Especially in early stage. I think it's different, right? Different strokes at different stages. But I think if I'm really specific in this $1 to $5 million, like, that's my sweet spot. That's me acknowledging where I can be the most helpful, and where, I'd like to get involved initially. I think that might just not jive with food and beverage. But I could be wrong. Again, like, somebody else out there can have this amazing track record of success, and that's where they invest in, but it's not me.
One of my favorite reactions from you when we spoke, must have been like a couple of years ago, or maybe a year ago, was, what do you think about all of these kind of food and beverage VC firms also expanding their portfolio to include beauty, personal care, which I know that's kind of your bread and butter. And I was like, the margins look great. and you said, well, the margins look great, but but have they seen the marketing spend? Because the marketing spend is always a lot higher in beauty and personal care. What do you think about today's landscape in terms of investing in beauty personal care from the investor perspective? Because it seems like it's become a pretty hot place to and in the early stage side to invest.
Well, I think it encompasses wellness now, which I can't remember if we talked about that in the last pod that we did. And I think you and I talked about this, or maybe it was on another podcast, but it's interesting how everyone's definition of wellness has changed. You know,
Yes.
wellness to me a decade ago honestly felt like a candle company, maybe. Like you light a candle and you feel kind of good. Like I'm being super honest, right? And
Yeah.
this is just me as a consumer, not me as this is just me as a consumer. But I mean, it's interesting now, and I totally get it, that wellness looks like supplements. Wellness looks like, this overlap with health and sexual health and fertility and all kinds of things. It has these really interesting overlaps in beauty as well. And I think that I think it's a good thing overall that the definition of beauty now very much includes wellness. But I think it's made beauty in general as a category like wider too, if that makes sense. Beauty
Mhm.
isn't just now a makeup brand or a skincare brand or hair care brand because it now overlaps with wellness. I think the definition is much more far reaching. And it's a big market. It's a huge market. And so it makes a lot of sense for me that consumer generalist investors are starting to play more into what is a very big category, which has a strong track record of success from an exit perspective, where the landscape of strategic acquirers is so large. And so listen, I think I welcome it, especially from the perspective of founders. I mean, I'm not against consumer funds. I think they're necessary for the ecosystem, and so I think that it's overall a great thing. I'm hopeful though that with the resetting of the market in the last couple of years, like valuations went bananas at one point. And I can see that now has really come down. And I think we've now reached a point where it's no longer the cockamamie state that it was several years ago. And arguably many people think, me included, that one of the reasons why it got so overheated was because of the supply of capital and the sheer number of beauty investors, if you will, coming into beauty and really raising prices. So it's good to see that that's sort of come down.
Yeah, no, for sure. I agree with you that some of the beauty prices have been, or just in general, really in consumer, how it's come down
Sure.
over the
No,
past few
across the
years.
board.
Yeah,
Yeah.
across the board for sure, for sure. Manica, this has been such an amazing conversation.